Hey everybody, welcome to the morning market briefing, May 10th, 2022. Hope you're doing well. Pretty big show today, lots to talk about. Going to start off with probably the obvious story, at least as it relates to market implications. We'll get into the deep dive on what's going on with a bunch of stuff here in a moment, but ugly day yesterday for markets yet again after a tough week last week. NASDAQ really sold off going into the close, closed down close to 4.5%, S&P down more than 3%, Dow down about 2%. Things just really took it on the chin. There didn't really seem to be a safe place to be. Ben, talk to us about kind of everything going on and how do we maybe try to stop the bleeding here?
Yeah, and even energy stocks that had been doing quite well were down 6.7%. Tech obviously took it on the chin too, down 3.5%. It seems like there was some real selling into the close. Volume was up 18% over the last month. You saw volatility go up as well, obviously. We're bouncing a little bit today. No real consequential news on that. There's a lot of noise out there. Tesla's actually shutting in a little bit more of its production in Shanghai, but the stock is up. And clearly, I mean, if you just look at that, it demonstrates that the overall market is not really trading on the fundamentals of from the day to day of a lot of these companies. It's more the market sentiment and the mood, obviously, and we'll talk about it. There are some big winners and there are some really big losers even today, and we see that every day right now. But I do think that we did see a little bit of capitulation yesterday, but it's not nowhere close to the capitulation that we could see if this continues. President Biden will speak later today to address inflation. According to a spokesman, he says he will lay out his plan to fight inflation and contrast his approach with congressional Republicans' ultra MAGA plan to raise taxes on 75 million American families and threaten to sunset programs like Social Security, Medicare, and Medicaid. I don't really know where that he's getting that information. I don't expect a ton consequential today. We talked a little bit about potential stimulus or things that he might want to do in order to save his election hopes, but I think it's still a little bit too early for that. And I think that if there was something happening that was consequential, it would be leaking. So I expect that to be a bit of a nothing burger.
He's trying really hard to make ultra MAGA a thing.
Yeah. And I mean, who doesn't want America to be great? I mean, at the end of the day, I don't care what your political leanings are, but I don't think that is a negative thing. Obviously, the connotation with it is negative to some people. So, but yeah, I think the market's up a little bit pre-market here. S&P 500 up about 1%, NASDAQ about 1.5%, gaining back a little bit of what we lost yesterday. But I think in the morning, the pre-market conversation that we were having, I think all three of us can agree that we don't expect the market to be up 1% today. Now, maybe that's up 3%, maybe it's down 3%. I don't know what it is, but I don't think it'll just be up 1%.
Yeah, when the market's up 1% pre-market, it's almost like being up 2-0 in hockey. It's the most dangerous score to have. More teams lose after they go up 2-0 than not. But I think there is a little bit of optimism today. If you look at the bond market, I think you can really see it. We led into yesterday with, the highest the 10-year has been all year. And today we're back under 3%. We're about 298 today. So there's been some extremely strong buying in bonds over the last 24 hours, which I think helps set a little bit of a backstop. I think we were a little oversold there. And I think this is a nice, hopeful foothold, at least for the next day, until we get CPI tomorrow. And, after that, all bets are off depending on how that number comes in. But we're starting to see steepening on the yield curve. We're starting to see a little bit of rationality coming in there, which we have not seen. And we'll kind of get into that in the next topic with the Fed release on the financial stability update. But we're starting to see a little bit of traction in bond world where we have not seen it, in quite some time. So I'm a little optimistic there. But the stock market could be quite volatile today, but the bond market could as well.
Yeah, I think as I think of the day and as we're set up for trading to begin here in a little less than an hour, I think my base expectation is that we end up for the day, we close somewhere between being down about 1% on the S&P and up 0.5%. I think anything outside of that range, to me, is going to be a further indication of sentiment. I'm not really reading into sentiment in pre-market trading. If we were to close up, call it 1%, 1.5%, I think that might be a potentially good indicator that at least for the short term, potentially we've bottomed out. We might see a little bit of a rally, especially if CPI comes the way people want it to tomorrow, and could see a little bit of relief throughout the rest of the week. If we close down south of 1%, I will probably be of the camp that it almost doesn't matter what the CPI print is, whether it's higher or lower, exactly what expected. I think it may just be a read through on overall pessimism. But Tom kind of teased this out. The Fed did release its semi-annual financial stability update. Tom, what were the big takeaways there as it relates to liquidity within the market?
The big takeaway is the liquidity has dried up quite a bit. And that was, what the Fed did when they came in March 2020, when the bond market was cracking and falling apart, was they basically put a backstop in for liquidity. They basically said, we're going to be a market maker. We're going to be the buyer of last resort. And that firmed up the bond markets. And if you look at, we've had a handful of clients who have needed to raise cash specifically for bonds. And, I've known about this for a while, because if you go out and try and sell a bond right now, you're going to have a really tough time getting a real market price. I mean, on Friday, I was trying to, find a home for some Denver, Colorado bonds, AAA state or city geos. I mean, very, very clean bonds. They trade right around $100 a bond, and the bids came back in the high 60s, which is just comical. I mean, you're looking at 30% down. And the reason for it is that nobody wants to buy the bonds. And so that's essentially what this update says, is that, there's not, a ton of buyers on both sides. It's not like most market forces are pushing against each other. It's essentially, you're pushing against air in terms of trying to sell bonds right now. And so they basically said there's been some deterioration. It's not been as extreme as some past episodes. And I think they're really speaking specifically about March of 2020 there, but it's definitely become a little bit of a significant risk that, if you're selling into the abyss, you're going to get worse prices on securities. And, the worse the credit quality, the worse it's going to be. And we're looking at, when we've had to come out of stuff, very, very high credit quality, very liquid things typically, and you're not seeing much of a bid there. So, if you're out there trading in, some of these things that are a little more esoteric, things like leveraged loans, which were very popular in the last 24 months because they were probably the yieldiest thing in the market, you're probably getting no bid. Nobody wants to hold that paper. Regardless of whether it floats or not, the credit quality is so poor and the market is so small that you're probably getting no bid, which means you can't even sell stuff if you wanted to, which is why we like to play in the most liquid markets possible, because if we do have situations like that, we can always come back another day and find a buyer. But I mean, it's definitely deteriorated quickly. And, the Fed has essentially said this time we're not stepping in. In fact, we're raising rates. We're getting more and more hawkish, which could continue to further erode the problem, though we are seeing quite a bit of strength this morning on the bond market. So things do seem to be improving naturally just in terms of the day to day. But, this is a little bit more backward looking.
Well, and we don't have to have a big debate about this because we got a lot to get to.
Do
today,
it.
But I just don't know who's writing this stuff from the Fed. They come out with this stuff every 6 months. They talk about liquidity and the rising liquidity risks in markets. They specifically cite commodities, which actually liquidity in the wrong way. Things just blow off tops.
Yeah, everybody's
and
buying
things like oil and everything like that. They talk about equity index futures and recently issued U.S. cash treasury securities. They don't talk about mortgage-backed securities, which have absolutely blown apart. They don't talk about municipal bonds, where you can't find a bid for a Denver, Colorado bond to save your life. I mean, I don't know who's writing this, but it's not people who are involved in the markets. That should be concerning to market participants. I mean, it just shows that the Fed is really removed from the situation, and they're not, like you said, they're not stopping it.
Yeah.
Yeah, it's weird. I would also, you mentioned kind of the leverage loan portion of portfolios. I would think if you're having these liquidity crunches, just being even in open-ended mutual funds has got to be a terrible spot to be, because that's the easiest thing to dump. You can get priced out where you are, but you're going to be priced out pretty low. And as you sell, you're going to continue to push that price down. I think that's a tough spot to be in.
You also don't want to be the last person owning that open-ended mutual fund, because you're going to get stuck with all that mark to market.
Yeah, not only that, but the easiest thing to sell if you're a mutual fund is the highest quality stuff. And so what's going to be remaining in that mutual fund is not going to be indicative of what they're trying to do. They say, hey, we're only in AA bonds, but you've got some lower end AA bonds. Just because they're rated AA doesn't mean they are, but you're going to sell the stuff that's really clean first because it's really, really liquid, and then hope for the best on what remains. And so I think it's, being in an open-ended bond fund right now would be a very, very tough spot to be. It's very reminiscent of, call it summer of 2015, sort of taper tantrum, the great sell-off that killed Bill Gross, the bond king, and his reputation, because he's just, these things are behemoths. They have to sell. They have to sell no matter what the price is, because you have to be liquid in a day. So when they get that bad bid on the Denver, Colorado bond, they have to sell it there because they need that liquidity. And so it's a really tough spot to be in. And, you proportionally participate in that sell in a bond fund. Whereas if you hold it, we don't have to sell the bond. We can look for another day. We can wait a month. We can find other bonds to sell that are trading better in order to create liquidity. That's not the case if you're in a bond fund. And so it's going to be really rough on people's, monthly statements when they start to see the big outflows in these bond funds.
Yeah, and it's even on the individual bonds. We'll move off this point here in a moment. But even on the individual bonds, man, I was communicating with a client recently on fixed income portion of her portfolio. And at the end of the day, we feel great about the credit quality. We feel pretty good about the yield that we're getting for it. These things are going to price in a adverse way. If one of these bonds has traded at a lower price, that is the most recent marketplace price, and that is going to be the price you see in terms of your statement. But at the end of the day, unless we have concerns about the credit worthiness of one of the companies, bonds are going to generate a total return between the purchase point and maturity that is exactly what we expected.
Absolutely.
And that's kind of the big reminder to people out there. Small business optimism index holding steady at a pretty bad rate, 93.2. Small business expectations for better conditions are sitting at a 48-year low, net negative 50%. Only 3% of company owners say they saw higher nominal sales in the past 3 months. Been a pretty bleak report that also lends itself to kind of the labor issues in terms of trying to get people in the door, even with higher wages. That's not always working.
Yeah, it's not working for on the labor side. That didn't deteriorate on a month over month basis, but more so from this report was just the general malaise that I saw from it. Small businesses really not optimistic at all, as the 48-year low suggests.
Travel bookings, kind of interesting data coming through. Wall Street Journal reporting on this. Airline website visits are still very strong. Lots of people going to delta.com trying to book a flight, things like that. But booked tickets, people actually buying flights is really starting to lose some momentum. And it seems as if the biggest factor there is just the price. A good quote here: in April consumer confidence survey by the Conference Board, a private research group, the share of respondents who said they intended to take a vacation in the next 6 months actually dropped to its lowest level since last spring. Yeah, that's a new data point, in my opinion. I mean, even just a couple of weeks ago when we were doing our macro presentation, we were talking about a massive shift away from goods and into services. We were talking about, some of the peaks we saw in travel spending going into February and March, things like that. But starting to see that really slow down. Ben, obviously airline stocks potentially impacted by this, but do you think this is a sustainable trend? I mean, it's got to be alarming that we're heading into summer months and we're seeing travel decline.
I think airlines completely overplayed their hands. I think that they had a really good hand. They came out the April conference calls from all these guys was extremely cocky. Like one of the CEO of United Airlines actually bet his CFO. The stock was trading at like 47, 48 at the time. He bet his CFO that the stock would be over $50 by the time the conference call was done. Like when you're seeing that bet and that type of arrogance, these are people who aren't concerned about price and think that they can just milk that cow ad infinitum. And what we're seeing is elasticity is actually a thing. Economics is a thing. When you raise price, you reduce demand. And that's exactly what we're seeing in airlines. I expect that we might begin to see some relief on ticket prices. I would hope that because these companies are actually generating significant profits now. So they have room to cut prices, but for now, it seems like some of those travel plans and some of the anecdotes in that article were interesting. People taking 3 trips, now they're maybe doing 2, maybe one of them's a driving trip closer to home, things like that.
I think the frustrating thing about that too is that they all got bailouts. A lot of these guys wouldn't have jobs. So it's really easy now sitting back after getting cut a big check to stay in business to be like, oh man, we're crushing it. We're raising prices. It's all flowing through to consumers. But then you look back, when they all got the massive $10 billion packages to stay in business, it kind of eliminates, almost like when we talk about those companies that drag along the bottom. And then when interest rates go up, they go bankrupt. This is kind of the same situation. You don't have to be a great operator if when things get really bad, you just get a check from the government to keep you in business. And so I think that's what's frustrating about the really high prices is that, they don't potentially have to be that high. And, now people are kind of like, hey, let's get out. COVID's over. Let's go for a trip. And they've got to, pay $2,000 to fly to California. I think it's kind of a sour taste in people's mouths. And I think the stock market is recognizing that.
Let's talk a little bit about some individual winners and losers. Lots of news coming through, some in the form of earnings, some in the form of potential acquisitions. AMC, the famous meme stock, up 6%. Admissions revenue was higher than expected, driven primarily by pricing. Attendance was still relatively light. Posted a loss of 52 cents a share, but Q1 was a weak quarter for movie releases. AMC up 6%. Interesting to see companies like that still kind of find a path and find some water to swim in. The interesting one to me is Microchip. It's up 3%, but Ben, you think it should be up a lot more if this were a more healthy market dynamic? What was going on there?
Yeah, I think it should be up double digits, frankly. It was an extremely strong number that they posted despite China, Russia, supply chain, all this stuff. Not being able to get equipment. Really good results for the quarter, really good guidance. Now, Microchip doesn't play in the smartphone industry. The smartphones is the weak segment of the market right now. If you're in semiconductors, you do not want to be selling semiconductors into the smartphone industry right now. That is soft. A lot of that's driven by China, but it's a global phenomenon as well. Microchip doesn't do that. They have a lot of legacy chips. Analog chips, things that have been used for 10 years. That's where you want to be. They have backlogs that last through 2023. They feel really good about where they are. And usually they are the first ones to come out and try to call a cycle. They love calling the cycle, and they're not calling a cycle here, which I take as good news.
Yeah. On the losing side, and then we'll come back to some acquisitions. Upstart down 48%. This is a stock that hit $400. 7 months ago, absolutely been clobbered. It's at $40 now. They cut their annual guidance and started to express some concerns about really kind of the entirety of their consumer base. Ben, kind of explain how that might actually translate more towards companies we would actually be looking at.
Yeah, fintech, I think, is finished as a near-term opportunity. I think if you look at Square, if you look at PayPal, all these companies have just been clobbered because people are consuming less and credit quality is deteriorating a little bit. Upstart, what they do, they call themselves a cloud-based AI lending platform. Great if you're in the SPAC meme craze, terrible in today's market. Basically, they cut revenue guidance from 1.4 billion to 1.25 billion. What their goal is to, quote, approve more applicants than traditional credit score-based lending models. So basically, people who wouldn't be approved because of their FICO score, they're saying, well, they've paid their rent check for the last 15 months, so they should be approved for this. There's a reason those guys don't have good FICO scores. And so figuring out machine learning around that, it's fine, it's whatever, but there's a reason that these people don't get loans.
I think the real read through here is if any company presents themselves as the X of the future, people do not want them right now. It's the car company of the future, pass. If it's the lending system of the future, pass. I mean, it's just people are concerned about right now, and people are not concerned about the future. And I think that's really what we're seeing in a lot of these companies. It's like you think you get the next best thing. We'll wait on that. For right now, we're going to work on the right now best thing.
Yeah, Uber kind of along those lines, down 11%. They're trying to transition into actually generating cash flow. They're cracking down on hiring, make it more of a privilege, trying to keep expenses in check. I mean, I think this is going to be a very, very painful time for Uber. I think they're trying to position this as if, they're being proactive and we're moving a little bit away from growth towards a value story where we're going to really generate profit. CEO sent out a long letter to employees and others that really kind of outlined, I guess, maybe the third phase of Uber's life trajectory. At the end of the day, if this were happening in a period in which Uber had been experiencing substantial growth and significant financial improvement, I think that letter would be pretty meaningful. And I think maybe the street would view it as something where they're saying, okay, we need to rerun our models we're moving from one trajectory to a more sustainable trajectory. The reality is I think they're doing it because they can't hire people. I think they're having massive problems, and I think demand is dry.
I think it's maybe because they can't hire people, but also because they can't afford to, because I think that they're getting massively squeezed by fewer people willing to pay the money for an Uber and the cost profile of the drivers. And which means that when you hire for corporate, it's tougher to hire. But Uber's had a ton of issues with employment really since its founding. And it seems like that hasn't really changed.
Yeah, we won't spend much time on this, but, Bitcoin, before we get to some acquisitions, Bitcoin just continuing to kind of take it on the chin, was in the $30,000 range. It's down 32% this year. So for all those people that, really preached the validity of Bitcoin as a hedge for inflation, well, the number one concern we have right now is inflation, and Bitcoin's getting absolutely hammered. For those that said it was a good hedge against market volatility, well, the S&P is down, 15, 16% this year. Bitcoin's down twice that. So some real cracks in the crypto line of thinking. Bitcoin's not isolated there by any means, but things getting ugly there, getting ugly in the NFT world, all of that kind of stuff. We did hear from Peloton. We'll hit that briefly, but Peloton just absolutely hammered down 28%, to $10.20. This was over 125 not all that long ago. Continuing to have trouble, not as much cash on the balance sheet as they had. Inventory is becoming a concern, and they're just having trouble moving product.
Yeah, their cash was cut in half on a quarter-over-quarter basis. In 3 months, they went from 1.6 billion to 880 million. A lot of that's tied up in inventory. But what they say on inventory, they say the obsolescence risk is negligible, and we believe that inventory will sell eventually. So this is primarily a cash flow timing issue, not a structural issue. I think if we've learned anything over the last year, it's not to trust temporary/transitory. And when you're cutting prices on your equipment because you can't sell it, that is the definition of obsolescence.
Yeah, that's the definition of a melting ice cube.
So Peloton, I think it needs a bailout, and it needs a bailout in a big way.
Yeah, they opened their press release by saying turnarounds are hard work. It's intellectually challenging, emotionally draining, physically exhausting, and all-consuming. It's a full contact sport. We're talking about a bike company. If you're riding a bike and it becomes full contact, you did something wrong.
Especially if you're doing it inside your own house.
Yeah. Something went really, really
you might have fallen off the treadmill.
Yeah. Maybe. They have had trouble with the safety of their treadmills. Let's not forget that.
Yeah. Super long call today. We got two more things. Philip Morris looking to acquire Swedish Match. Swedish Match makes Zen and other kind of snooze-like products. The deal could be worth $15 billion. It's a decent premium to where the stock's trading now, but I feel like it's pretty fair value for Philip Morris as they're trying to kind of diversify their offering. And the stock's just been hammered over the last several months. And lastly, we do have Pfizer making an acquisition of Biohaven. Pretty steep premium here, Ben. Justify this for Pfizer.
So Pfizer had a very small stake in this company, Biohaven. They have a ton of cash just piling up in their balance sheet. I call it COVID cash. They're going to do about $60 billion in sales this year alone, between its vaccine and its therapeutics to governments. Huge margins on that stuff. That's just been piling up on their balance sheet. It's not been a great company before COVID, but then they just have this windfall, manna from heaven, just into their lap that they're now going to be able to redeploy into other deals. They were never going to do a one-time big special dividend. So that was off the table. So the stock is actually down a little bit today, but Biohaven, it's a huge premium, closed yesterday at $83 a share. They're buying it for 148. So massive premium on that. But I think that this makes a ton of sense for Pfizer. We knew they were going to do a deal. It's nice that they know the company, they know the products. They already had a small investment in them. Price is steep, but when you have that much cash, it doesn't, I hesitate to say this almost, but it almost doesn't matter how much you pay because you're going to have to deploy that cash. And if it's earning any money, it's going to be better than holding cash on your balance sheet, and it gives them more growth avenues in the future. So I think it's probably a good deal for Pfizer. I wouldn't be surprised to see the stock up today.
All right, we're going to wrap it up there. Thanks for bearing with us. I know it was long. We had lots to cover, but hope you all have a great day. S&P futures up 1.14% right now. So let's just hope that holds, and maybe 10% day would be nice. Let's get it.
Push.